This is Tom Asper with the Viper Report. Been a couple of weeks since my last update on T&J'S sector analysis and watch list. I took a week off and went to see the eclipse in Maine. Here's a shot. It was total. It was taken about 2:32 p.m. Eastern Time. Very spectacular. This is a more close-up shot when the eclipse was total. And if you've not experienced one, try to do it in your lifetime. I probably can't see me in the back of this photo, but I hope you will notice the bottle of Dom Perignon in the ice waiting its uncorkage after the total eclipse was over. Let's get to the markets. The week ending April 5th, we started to see some changes in the ETF report. Let's look at it first. As it dropped in terms of the number of ETFs above their pivot, went from 84.4 down to 66.7, and more importantly, there were 13 new negative weekly sell signals, including 2 of the high-yield bond funds here that signaled the recent uptick in rates, as well as healthcare, biotech, etc. Now only 66.7 of the growth ETFs were positive, and also the value ETFs. More importantly, possibly, is the fact that all of the short ETFs now showed positive DTS signals as of the close on Friday the 5th. And all the leveraged ETFs were negative. That's what you'd expect to see. As for the sector watch list, energy was still strong at plus 100. Everything else saw a downturn, some quite significant. You can see the financials, the XLF dropped from 63.3 from 81.8. XLY, XLV also dropped. XLK went to 33.3. It was at 66.7, and as we've noted in earlier videos, turned about at plus 100 in early November. Not too many ETFs were positive that week. Looking at some of the individual sectors, once again, this is after April 5th, you can see lots of red in the consumer discretionary here. Very few. Amazon was totally green. Everything else looked pretty weak. If you go down here further, financials, a bunch of reds starting to creep up. Information technology had gotten hit hard, and consumer services were handing up a little bit better. The deterioration in the sector analysis dovetailed with some changes in the advanced decline line analysis. So this is the S&P SPY chart, S&P 500 AD line, stocks only AD line, and all AD line as of the 3rd of April. So we'll advance this. You can see on the 4th, we had that key reversal. If you don't know what a key reversal is, go to the Viper report and read the article. There was a significant key reversal to the downside on July 27th, and that kicked off a correction that lasted a few months. I don't think we're going to see the same length of correction here, but keep an open mind. You can see below this, the AD line dropped barely below its moving average. Stocks only stayed positive, as did the NYSE. So we got another really bounce up here into, this is as of the 10th of April. That was last Wednesday. And then you can see it tried to get a rally attempt that failed. This was as of the 12th, as of last Friday. And you can see now that the AD lines here have dropped below the moving average, confirming that the market was in a corrective pattern. In last week's commentary, along with the ETF and sector reports, I noted that the deterioration in the bullish sector readings was a sign of a weakening market. I pointed out that 42% of the ETFs closed the week above the quarterly pivot, down from 67.7, and there were 26 new weekly signals. Now, only 44% of the growth ETFs were above their quarterly pivots. Usually it drops below 50. That turns the market outlook negative. And of the value ETFs, they'd also weakened further. So all of the short ETFs and the weekly DTS for TZA turned negative last week, and it confirmed by all the leveraged long ETFs, had turned negative. There were a number of new negative weekly DTS signals, including XLY, XLF, XLP, as well as RSP, which is an equal weight S&P 500 ETF. XLE dropped to 91.7, but you can see what happened to a couple of the prior leaders. XLB and XLU went from 75% down to 41 and 58.3. XLF also got hit pretty hard, and XLK actually picked up a little bit last week to 41.7 from 83.3. Okay, so pretty much, it was a rough week last week. XLF, XLB, and XLF were down over 3%, while the tech sector held up pretty well. In last week's sector report, you can see there was starting to be some deterioration in the energy, down to 91.7, quite a bit of red in here, and crude oil and most of the energy ETFs are lower this week. We're going to see a lot more red when I run this report on Friday afternoon. Materials also, it's one of the ones I like longer term, but you can see it's mostly red. Same thing for industrials. Consumer discretionary was one of the earliest ones to peak out. Still just Amazon and CMG are on the all plus sign, but it's getting down typically into the start to be oversold level at 25%. Now, based on the longer term market analysis, I think this is a correction that's going to be a buying opportunity. I'll give you the link to my most recent article in Forbes.com, but essentially the main question is whether this is going to be a 2 to 4 week correction, or whether it's going to be a brief one that we saw in the end of 2018. So I'll be looking at these analysis. You can see consumer staples, healthcare, almost all red. All right. Financials, same thing. Information technology, XLK is looking a little bit better. So I'll be watching particularly two of my longer term favorites, XLK and XLC, for signs of a change. And that will first appear typically in like 1 hour and 4 hour DTSs. We can see Cisco just turned negative as of last Friday. Not a lot. NVIDIA is still positive, as is AVGO. But so I like to see for changes in here to shift to a change in trend. Utilities back down into negative territory. Look at real estate. It's almost all. So it's back in oversold territory as rates have gone higher. At the end of March, there were some warning signs that I pointed out in my contribution to Forbes.com, because the AD lines were looking very strong, as I pointed out there, but we saw this behavior in the SPY, the monthly. We can see we made it above the monthly Stark bands. These bands are designed to encompass about 92% of the price activity. So if you're near the upper part, it's a higher risk buy, a low risk sell. Conversely, down near the lower part, as in the COVID load, it's a low risk buy and a higher risk sell. So that was the first thing we saw that was a negative, and confirmation came the following week with the sector number. In my latest article, I put out the fact that stocks had moved into the corrective mode, but that I was not expecting anything like what we saw last summer. And the fact that many people were turning bearish already was probably a good sign. I explained the Stark bands here and the kind of warnings they give, which I think you'll find beneficial. I also discuss what happened in early 2018. Bullish sentiment got very high. We moved above the Stark band, corrected like about 11% in like 7 days in January, and then resumed the uptrend for a good part of that year. So if you want to read more, once again, you can see the link. Here's where I updated the AD line analysis. And also on the QQQ, it had been holding up a little bit better. Interestingly, the relative performance analysis is trying to bottom out. So the Qs may come out as a leader once this correction is over. So I figured the AD line analysis will point that out. If you want to learn more about the techniques that I use, please go to theviperreport.com. Also, you can find that article I mentioned about spotting the Q reversal. You can see this was the one that happened in July of last year. We had a secondary one here as the correction developed into August, September, and even October. If you'd like specific recommendations on ETFs, you can go to the ETF report here, sign up, $34.95, or hot stocks. And of course, I do offer advanced training and provide to my students some of the formats that I use in stock charts and training also in how to use stock charts. That's all I have for this week. Won't have another eclipse picture until 2044, but hope some of you saw it. I'll have another update next week. Thank you.